Thank you for watching. I will be explaining a 4-step investing checklist that Charlie Munger gave in 2009 to the BBC. The checklist is a simplification, but I will interject with the thinkings and philosophy of Warren Buffett and Charlie Munger for each of the steps. Also, I highly recommend watching the original minute-long clip before this explanation.
We have to deal in things that we're capable of understanding.
Charlie Munger and Warren Buffett describes one's capacity with the circle of competence. The basis of the circle is the practice of humility and our abilities to assess investments. For instance, Bitcoin has been all over the news. But remember, Facebook destroyed MySpace because it was just a better version. So if you don't understand the technology and its forthcoming forks, competing coins, future regulation, especially in the US, hack threats on the platform, wallets, and trading centers, and don't forget global economics, then it's outside of your circle. Granted, you don't have to be a programmer to invest, but you need a level of exposure to be capable to understand. Therefore, it's always best to start with what you know, and more importantly, what interests you. Look at what hobbies you have, where you eat, where you live. We assess everything we pay for, and with some thought on your interests and spending habits, you can find an investment after some research that you are capable of understanding.
And then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage.
Coined by Warren Buffett, a moat is the sum of the intrinsic characteristics of a business. And just like the width of a moat determines how well it protects a castle, the amount and quality of the intrinsic characteristics matters for the business. The major categories that the intrinsic characteristics fall under is 1. Intangible assets, such as brand, like Nike. 2. Switching, for instance, Apple, once you're fully integrated with your apps, it's really tough to leave. 3. Network effects, such as railroad, and no one's going to build competing tracks, so they're good. And 4. Cost advantages, such as Disneyland has an amazing location of being in Southern California, where the weather is great year-round for visitors.
And then, of course, we would vastly prefer a management in place with a lot of integrity and talent.
As everyday investors, we aren't able to meet with management of any investment, but we are able to track their performance by examining the growth rates and making sure they're sound, by looking at industry-specific trends through quarterly and annual reports and comparing them to their competitors, and lastly, how is management compensated? Where executives get their money is important because investors must assess management's success and how that aligns with us, the investor.
Finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life.
The final step is waiting for the margin of safety, which is the strategy of not buying until the price is below the evaluated value of the investment. Thank you for watching. I will be further explaining each of these steps in Charlie Munger's investing checklist in future videos, as well as how to evaluate companies like Charlie Munger, Warren Buffett, and other great value investors do. So if you liked the video, please like it. And if you want more content on value investing, finance, and cryptocurrency, please subscribe.